Good morning, good afternoon, good evening, ladies and gentlemen. Welcome once again to our episode on investment or investing, the world of investment. So this is just a continuation. So today we're going to look at the avoid common mistakes, the common mistakes which you have to avoid when it comes to investment. So the common mistakes is like before, during and after investing. These are the common mistakes. So we're going to look the first point. It will be on the emotional investing. You have to avoid that, number one. Number two, lack of diversification, spreading your investment all around the places. Number three, ignoring fees and costs, which are like the high prices, which can act as red flags. Number four, we're going to look at the chasing high returns. You have to stop chasing high returns. Number five, it will be about neglecting a long-term strategy. You cannot neglect long-term strategy. So those are like the mistakes which you have to avoid before, during, and after investing. Number six, we're going to look at the failing to continue learning. Keep educating yourself. Number seven, overlooking emergency funds. And then I'm going to give a quick summary at the end, just as I usually do in all the episodes, just to sum up really everything that which we learn. So get tuned ready, ladies and gentlemen, tighten your belt, and let's begin. Let's begin, ladies and gentlemen. Avoid common mistakes, or the common mistakes which you have to avoid during, before, and after investing. So investing can be a powerful tool for building wealth. It is a powerful tool for building wealth in the long term. So, but there are several common mistakes that can hinder your progress. By being aware of these pitfalls, you can avoid them and stay on the path to financial success. So I'm trying really to bring you back to the root, or back to the straight line really, in order to reach the success, the land of success, the promised land of success. So I'm going to take you through the common investing mistakes that you must avoid. Number one, emotional investing. Avoid panic selling. So one of the most common mistakes is letting emotions dictate your investment decisions, especially during market downturns. So selling out of fear is when the market drops, can lock in losses and prevent you from benefiting for future recoveries. So don't invest in fear, or don't be in fear, don't make fearful decisions. So it is all about avoiding panic selling, panic transactions, selling and buying. Don't make fearful decisions. So a quick example, because you have to be practical, a practical example. So like during a market crash, like the Wall Street, the 2008 financial crisis in America. So it is tempting to sell your stocks to avoid further losses, but staying invested usually leads to better long-term outcomes, as the market typically recovers over time. So even though there's a market crashes or financial crisis or market or something like that, you still have to stay calm and think about the long term, not in the short term. So you have to balance, you have to weigh them, the losses and profits in the long term. Two is, we're still on the emotional investing. Resist the urge to time the market. So resist the urge to try to predict everything really, to time the market. So trying to predict the market heights and lows is extremely difficult. Even for professional investors, it is difficult to try to predict the highs and lows, when the price goes high or when the price drops again. So instead of trying to time the market, focus on a long-term strategy and consistent contributions. So you have to focus on the long-term strategy, like 10 years plus, and you have to be continuously contributing in your investment account. So a practical example for that, it will be like, instead of selling when you think the market is at its peak, high, like maximum, or buying when you believe it has hit low or below, stick to a disciplined investment schedule, like euro cost averaging. So instead of like going with the trends, when the price goes high, you say you want to sell, when the price goes low, you say you want to buy. You try to stick up, like in your long-term really investment, trying to stick up with your own schedule. Number two, lack of diversification, lack of spreading investments all around the places. That's the meaning of diversification. So it's like spreading all of the places. Don't put all your eggs in one basket, or try to test the water with one foot. So investing all your money in a single stock sector, like it's technology or tech sector, or asset classes, can be risky. So in the case of asset class, it can be like stock, bonds, mutual funds, the ETFs, the exchange traded funds. It can be just maybe the index funds. Index funds are much better because the diversification is automatically applied in the case of low cost index funds. So don't put like all your money in the single stock or sector like tech or one asset class like real estate. So if the investment performs poorly, it can significantly impact your overall portfolio. Like a portfolio said that is just a financial investment, significantly impact your overall portfolio. Like diversification helps spread risk and can lead to more stable returns. So in the case of stable returns, that might be like bonds, low index funds as well, low cost index funds, and mutual funds. Those are the stocks or the assets classes which are more stable than compared to cryptocurrencies and stocks. So a quick example of lack of diversification, it will be like, instead of investing only in the tech stocks, consider a mixture of sectors, e.g. like example, the healthcare as well, consumer goods, and energy. All of those are like different sectors instead of just focusing on technology or tech sector. And asset classes, different asset classes as well. So you diversifying all your investment around the places. Like you can put some in the stocks, some percentage in bonds and real estate. So it's like diversifying, dividing really your investment choices around different sectors and the different asset classes. So overconfidence as well in individual stocks, being too overconfident, you think you know everything, like that's the like being overconfident in an individual stock, in one stock, so one or two stocks. So that's the overconfidence. So it is easy to fall into the trap of believing that a particular stock will continue to perform well indefinitely. So it's like you're believing there will not be any drop, it will keep increasing, or it will just stay stable or balanced. However, even strong companies can face unexpected challenges. So that is why I said in the previous video, certainty is a dream. Nothing is certain, nothing seems as it is. Even strong companies can face unexpected challenges as well, like bankruptcy, market fall, market crisis, something like that, financial crisis or market crash. So a diversified portfolio helps mitigate the risk of individual stock and the performance. So diversification here is the key, where more emphasis is being put on. A quick example of that would be like, if you heavily invested in one company, consider spreading investments across several companies or sectors to reduce risk. So you have to reduce the risk as well, not just betting on one place. So try to bet them in different places. Even if this one fails, one stock fails, the other places you still have like a 90% or 80% to guaranteed to get you your investment return back. So number 3, it will be like ignoring fees and cost. Some people usually ignore the fees and cost. So it's like the higher prices are red flags in the case of investment. Watch out for high prices. Don't ignore the high prices. You have to watch out for high fees or high prices. So investment fees such as expense ratios, management fees, and transaction fees, which is transaction simply is based on buying and selling, can eat into returns over time. So all of those fees, expense ratios, management fees, transaction fees, can eat into return over time. So return is like the output really after you input, then in the long term. But if you're going to pay all of those fees, like management fees, transaction fees, the expense ratios, all of those will affect your return at the end of the day, at the end of the month, the end of the year, annually. So even small fees can add up significantly over the years, like reducing your overall wealth as well. A quick example of that, practical example. So it will be like a 1% annual fee. Might not seem like much, but over 30 years, it can reduce your investment returns by thousands of euros. So I said I'm going to use euros in all my videos, not pound or dollars, because I simply live in Europe. So opt for low-cost index funds or the ETFs, which are exchange-traded funds, to minimize fees. These are more stable. Mutual funds and low-cost index funds, all of those are like stable investment, which you can go for. Investment classes, which are better to choose. Be mindful of taxes. We're still on the people ignore the fees and the cost as well. You have to be mindful of taxes, paying taxes as well. That's what most of the people forget. They simply think it is all about investing and just generating money. Your money start accumulating over time, but you have to pay taxes as well at some stage. So taxes can also impact your investment returns. like capital gains tax, for example, are incurred when you sell an investment for profit. So when you sell an investment for profit, you're going to pay some type of taxes, really, like capital gains taxes. You're going to pay them after you sell an investment for profit. So if you gain any profit, then you have to pay tax on that. Like consider tax efficient investing strategies, such as holding investment in tax advantage like accounts or tax benefits accounts. The one I just said like in the previous videos. So it will be like the IRAs, which is just individual investment, individual retirement accounts, the IRA, or the 401 case, and holding asset for the long term to benefit from lower capital gains tax rate. So those are like ideal ones in the case of US citizens, really. Like in the case of 101 case, you can even take it out from the US, and even if you move in the UK, United Kingdom, you can still use your investment account to withdraw your money as well, your capital. So a quick example of being mindful of taxes is like, instead of frequently trading in a taxable account, hold the investment for at least a year to qualify for low long-term capital gains tax rates. So that would be like a trick as well, or secret. Instead of just frequently doing transaction buying and selling or trading in a taxable account, hold the investment for at least a year in order to qualify for the long-term capital gains tax rates. Number 4, you're going to look at the chasing high returns. So you want quick money, really. So you want high returns, you don't even think about the risk. Beware of get-rich-quick schemes. So that's the first advice. Investment promising high returns with low risk or little risk are often too good to be true. So if it is too good to be true, you have to avoid them as well. So high returns typically come with high risk as well. So in the case of stocks, the risk is equal, or the reward is equal to the risk. So high returns comes with high risk as well in the case of stocks or cryptocurrencies, which is simply based on the Bitcoin and Ethereum as well. You get high return investment, but the risk as well is high in the case of the market crash or market drops or downturns. And pursuing this investment without understanding the risks can lead to significant losses as well. So a quick example, it will be like the cryptocurrencies, which are Bitcoin and Ethereums, penny stocks, or like speculative investments might offer the lure of quick gains, but they can also be highly volatile, like unstable as well, and lead to large losses if not approached cautiously. So in the case of like taking calculated risks, you have to be more cautious in this case. Like in the case of if you're dealing with the crypto or cryptocurrencies or stocks, you have to be more cautious, really taking calculated risks. Doing your own research, that's the whole emphasize there. You have to do more research. If it is too good to be true, you have to dig deep inside just to see what is hidden behind, or what is hidden on the bottom. So don't follow the herd or the crowd. You have to be unique. You have to accept with the low or stable investment returns. So just because everyone else is investing in a particular asset does not mean it is good choice for you. So everyone, we're all unique. I said some people are too impulsive, adventurous, some people are cautious, some people are moderate, they don't care. So it is all about like risk assessment, like resilience, really trying to see how much you can cope with, how far you're willing to go. Don't try to compare yourself with someone who's going with a short-term investment. If you are going for long-term, you are not equally with someone who's looking for the short-term, like 2 years or 3 years. That would be like a short-term investment. If you're doing for long-term, that will be like 10 years plus. So you are not the same. Like the FOMO, FOMO, like fear of missing out. That's why most of people go with the herd or the crowd. Can lead to chasing investments that are overhyped or hyped or overvalued. Like stick to strategy and avoid getting caught up in trends. Don't follow the trends, don't follow the crowd. So going with the flow is not good. You have to be stable instead in this case. A quick example of don't follow the crowd. Like when a stock becomes popular and its price skyrocket, it can be tempting to jump in for majority of people. They'll be tempted to jump in. However, buying at inflated or high prices often results in losses when the hype fades or when the trends fades. Number 5, we're going to look at the neglecting a long-term strategy. Most of the people neglect the long-term. They just want quick money, short-term, like 2 years, 1 year or 3 years, and start complaining. But in the case of long-term, you have to say 10 years plus or 9 years. That'll be ideal. So focus on long-term goals. long-term goals. So short-term market fluctuations like ups and downs can be distracting. So, but there does not derail really your long-term investment strategy. So keep your long-term goals in mind and avoid making knee-jerk reactions based on short-term market movements. So a quick example for that, just to clear your misunderstandings or if there's any. So instead of reacting to daily market news, focus on your long-term, like let's say 10 years plus, your long-term goal, such as retirement or a down payment on a house, and stick to your investment plan. So instead of going with the daily trends, try to look in the long term, like 10 years. How are you going to invest? Maybe it is a retirement, it's about retirement, or you want to buy a house, or like in the case of mortgage, and stick to investment plan as well. We still are neglecting a long-term strategy, so rebalance your portfolio regularly. Rebalance is simply like going back to the original allocated target. And portfolio, is said, is just the financial investments, really, assets. So over time, certain investments in your portfolio may outperform others, causing your asset allocation to drift from your original plan. So periodically, rebalancing your portfolio helps maintain your desired level of risk. So in the case of periodically, you're trying to keep the equilibrium really, or going back to trying to keep everything balanced. So in this case, equilibrium is the key to success. So a quick example of that, practical example, it will be like if your stock allocation has grown from 60% to 70%, which is a 10% increase. Due to market gains, consider selling some stocks and buying bonds to bring your portfolio back to your target allocation. In the case of bonds, it will act as a backup returns. If the stocks goes too high, the stocks are like high risk returns. But in the case of bonds, you have low risk and low return as well. So they are directly proportional to each other. Number 6, we're going to look at the failing to continue learning. Most of the people fail to continue learning, gaining knowledge. Keep educating yourself. So stay educated. So the financial world is constantly evolving, changing, and staying informed is key to making sound investment decisions. So if you stay informed, you're going to make wise investment decisions as well, or sound investment decisions. So continuously educate yourself about the new investment opportunities, market trends as well, and financial strategies. So I'm not saying you have to avoid the market trends, but you have to learn about them, keep educating yourself about them. So in the future, you're going to avoid them really, or try to elevate yourself to avoid surprises in the near future or in the present. So a quick example of stay educated, it will be like regularly read financial news, books as well. Like I said, the books in the first videos, you'll find the books which I mentioned, two great books on investment, or take courses on investing to deepen your understanding and adapt to changing market conditions. So in the case of adaptation, it's all about being flexible or flexibility. Change is good only when you know yourself. That's one of my quotes. Change is good, but it is good only when you know yourself. We're still on number 6, failing to continue learning. Don't overcomplicate your strategy. Don't overdo it. Don't overwhelm it. Don't try to overcomplicate it, really. Don't exaggerate it. So while it is important to stay educated, avoid getting bogged down by overly complex strategies or information overload. So a simple, well-executed plan can often be more effective than a complicated one that is difficult to maintain. A quick example for that, it will be like instead of chasing the latest complex financial products, focus on building a diversified portfolio of low-cost index funds and stick to long-term plan. So you have to think it long-term always, your long-term goals, your retirement, maybe something you want to a house, like in the case of mortgage. You have to keep the long-term goals inside your mind, even though it is not too bad to have short-term goals as well. Number 7, like overlooking emergency funds. So in the case of emergency funds, we said it is like in the anything emergency, it's all based on the liquidity. So liquidity can be like saving accounts, it can be cash in the hand. So whenever you need it, you get it. That's like the emergency funds. Instead of saying I need 3k or 3,000 euros or 5,000 euros or 1,000 euros, you go to the bank, they say no, you cannot withdraw all of this money, or it's not available at the moment. So instead of doing that or going back and forth and trying to produce documents, you just need some kind of emergency funds in the short term. So maintain an emergency fund or liquidity. So before making significant investments, ensure you have an emergency fund in place. So an emergency fund, just cash would be a good example, a quick one. So this fund acts as a safety net. You need a safety net, so allowing you to cover unexpected expenses without having to sell investments at an unfavorable price. So when you have like some kind of backup, this is going to allow you really so to not to sell your investments when the price is not favorable in your case, or you have to try to avoid withdrawing your returns frequently before time. So you have to leave it maybe 1 year, 2 years. Just let it in your investment account, keep it increasing, keep growing or accumulating there. So we have a quick example for that, like maintain an emergency fund, like aim to save 3 to 6 months. The example which I keep giving the videos, 3 to 6 months is the worth of living expenses in a liquid or quick capital or quick cash, easily accessible account such as a high yield saving accounts or cash, before focusing on long-term investments. So this is a good example for those people who want to go with the long-term investments. You need an emergency fund account or a liquidity account. Avoid investing money you might need soon. So it's still on the overlooking emergency funds. Avoid investing money you might need soon. So if you need it very like next week or next month, that's like in the short term, don't invest it. Just keep it as a emergency funds or liquidity fund, the cash. So if you need money, like let's say for a short-term goal, like example buying a house or covering tuition as well, it is better to keep it in a safe like in your house, or safe any place you like, it is safe liquid account, rather than investing it in a volatile markets. So if you take the small money which you have and you invest in a volatile market or fluctuating markets, you might lose it instead of like keeping it safe in your house, liquid account. If you need a quick amount to buy a house, that will be like 2 years or 3 years. You keep that in the case of short-term goals. So in a quick example as well, we have to give like avoid investing money you might need soon. So it will be like keeping your down payment savings in a high yield savings or liquidity account rather than the stock market. So it is wise to keep your money in the saving accounts or liquidity account rather than to put it in the stock market if it is in the short term when you need it, when it is required. So where short-term volatility could reduce your funds when you need them most. So what can we say, ladies and gentlemen, in the conclusion about the common mistakes which you have to avoid before, during and after investing? So it doesn't matter if you're still a beginner, a newbie, or you are in the middle, average or moderate, or if you are an advanced investor. This video is still useful to all of you. So in conclusion or in summary, so we're going to say avoid common investment mistakes is crucial for long-term financial success. So by staying disciplined, diversifying, spreading your investments across different sectors, different asset classes, by diversifying your portfolio, financial investments, being mindful of fees and tax as well, and focusing on long-term goals, you can navigate the investment landscape more effectively. Keep educating yourself, avoid emotional decision makings as well. You have to avoid making decisions based on emotions, not being too impulsive, not making decisions out of fear or the form of fear of being left out. And remember that consistent, informed investing will yield or bring better results over time than chasing quick wins or following the crowd. So you have to try to avoid following the crowd, following the herd. So you have to try to be yourself and keep the word resiliency in mind as well. So ladies and gentlemen, I think this is going to be the final video on investment. I've done all the key topics which are needed to be said, or in the case of anyone who want to get on the road of investing or in the world of investment. I think if you look all my videos, if you go to the playlist on my YouTube channel, you're going to find all the videos there on the business, tech, investment, and religion, spirituality as well. So thank you once again for watching. Don't forget to like, comment, subscribe, and keep sharing the videos to reach more people as well, more engagement. Keep your comment coming. Thank you so much for watching. Ciao. Bye.